All right, so how has everybody's week been? Mine has been terrible. Went for my normal trade, was trying to get a little bullish upside pop from a squeeze right when Jerome Powell starts getting into the stuff that he wants to say. Didn't end up going well. I was up for a little bit and then it crashed way down because we had one interesting week. We had the Fed come out. They basically came out exactly the way we thought they were going to come out, except they were a little bit more hawkish. Now, we had a whole bunch of talk about a Fed pivot, and before Jerome Powell came out, I said, no, there's not going to be a pivot. I don't like making definitive predictions, but just based on the data, it's extremely unlikely there's going to be a pivot. And guess what? There wasn't a pivot. You know what they did? They did exactly what they said they were going to do, and that's important because that plays into our trading. So what did they say they were going to do? They said they were going to keep raising rates until they see meaningful decreases in the data. Then they're going to pause. Okay, they're not going to pull it back. Unless there's an emergency, unless there's a reason for them to come through and actually pull rates down, like something really bad ends up happening and they need to do that, they're not going to do it. All right, if everything stays the way it is, there's not going to be a pivot. You got to put some of the extreme stuff out of your mind when you're getting into finance and you're thinking about what you want to do with stocks. All right, because there's going to be so many people that have agendas, and then there's going to be so many people that don't know any better, and they get excited because they're getting into it and they hear somebody, they like what they say, and they repeat it. You know, like bearish stuff, especially. Bearish stuff is extremely popular. When you first get into trading or investing, you have a bunch of losses, you get all pissed and disgruntled, so then you discover short selling and you go the other way. And either you do that or you use options. Either way, you find out that you can bet on stocks in both directions or you can bet on stagnation. And you use those three different possibilities. But when people are new and they first find out about that stuff and they kind of dip their toe in, they maybe get some success once or twice as a bear, and then they're a perma bear. They're extreme. And normally, the market doesn't do that. If we take a look at the market over time, just to give you an idea. So this is the S&P 500 over time. And we've got this on a weekly chart. This can go back pretty far. You can see if you go back to the beginning of this thing. All right, so early in the 1900s, like right before the Great Depression, we had this nice huge pump in the early 20s, right? Or the mid 20s. It was just going up, up, up. Kind of like what we'd seen in the past couple of years. Things were just going crazy, and then we had this huge crash. So each one of these little spaces right here is a year. So basically, in August of 1929, we hit the peak and didn't start coming back out of it until 1932. So that's about 3 years, almost 3 years of downward movement. Now, in that time, there were bull runs, like there were little bull traps right here. This first, because you don't see a big drop like this without a recovery of some kind. Even if you're on a downward trend, this is such a huge move that people need to reposition because there are going to be shorts that are up so big that they need to get out of it, right? And then there are dip buyers that think this is insane. You got to come in and get it. And even though I don't like just going in on something because it's a dip, this was actually an opportunity to do that because it was moving so fast. I mean, it's like water. You throw a rock into water, the harder you throw it, the bigger that ripple's going to be. It's the same way when you're falling in a market because especially when there's a gap. Like these are weekly candles, so there was a huge gap between a couple of weeks. Actually, this looks a lot like the pandemic. The pandemic was actually it was a bigger drop, believe it or not. It was probably worse in 1929 because it's relative to their time period and what was going on. But the pandemic drop was a little more extreme than this. And it had a very similar reaction, except it kept going because we added some stimulus. However, we had World War II. We had all this stuff going on. So the market was stagnant for a while. Like if you bought into the American stock market in the 20s, you didn't recover until the 50s. Right. So post World War II, that's kind of the era we're in now. Like we kind of group ourselves by generations. Mostly it's like, oh, millennials, Gen X and boomers and stuff like that. But it's actually more the post-war era and then the internet era. That's kind of it. Right. Those are the two major eras that we entered after World War II because there was a great restructuring of the power on the entire planet. Like everything kind of changed and became the modern world after World War II. And if you look at where the stock market takes off, it's right at the end of the 40s, right? Because there's all this debt from the war and people think, oh, how are we going to pay that off? What are we going to do? There's still, elements of cleaning up after that. And then suddenly we start to pump, right? And we've kind of been in this pump ever since. So if I go over with this, you can see it's just up, up, up. There are some periods of downward movement, like we have a crash here. We have a crash in the 1970s. So yeah, 60s, 70s have their little crashes, but they recover, right? And you can see just over time, it just keeps going up. So being a bear in this market long-term is not profitable. And I mean, look at the degree to which this thing goes up, right? So if we're going back to the 1920s, you can see for a decade or two, it just didn't look like anything. There were these bull traps, runs for a couple of years and then they crap out, right? And then it's just sideways movement. We haven't been in an environment like that since then. So if you think about that, we're coming up on like 100 years of this almost. I mean, not really. It's probably like 80 or 90 years, but either way, it's still a huge amount of time. Like there are very few people alive that have a lot of memories of a time before this pump, right? The people that lived in this era are alive, yes, but most of their memories are after that point. I mean, that stuff still sticks with them, I'm sure. But this is the reason why you don't want to be too bearish. So basically, that's what I'm trying to say. Like, the bears are going to be overconfident. They're going to get crushed in the long run. But right now, they're doing very well. Why? Because if we go to the end of this massive pump, where we pumped a ridiculous amount of money into the system, we finally have a bear market. But look at what this bear market looks like. It's different than this is what previous bear markets were looking like. If you go back to the crash of 2008, and you move, right here. So actually, let's go to the dot-com crash. So the dot-com crash is more like what we were having now. It's more of a general downtrend after a huge peak. But then if you go to the 2008 financial crisis, that one, even though there was a downtrend beforehand, it was a huge slam down right here. And then kind of a consolidation. And this was when people gave up, right? This is when people were like, all right, I'm done. I'm getting out of it. But when that actually happens, we go boom, straight up. We actually end up having a pump because that's the time, right? When everybody is finally out, that's the time to get in, because the only way to go up is to bring people back in to lift prices. You have to, the solid traders have to stay in or re-enter or whatever it is, let it form a bottom, and then the people that want to FOMO in and the people that have all the money and they're kind of stupid, or they're not really stupid, they just don't pay attention, which is why I say stupid. They're just throwing money at things, which you really don't want to do. But that's how you move stuff up. I mean, borrowed money is going to move stuff up. People that want to come in and FOMO are going to move stuff up. But at some point, there's going to have to be a base where everybody that doesn't, or everybody that wants to sell is out. And that's what we're waiting for. I don't think we're there yet, right? This is kind of where we're going right now. This year, we've had this nice downtrend. We've had some pumps. Almost all of them were because of the Fed. And this recent one was an expectation pump and also kind of a squeeze because the shorts that got in right here needed to cover. And when we actually got the Fed meeting, we got some downward movement. We haven't usually had that. All right, we've usually had maybe some muted movement on the day and then some kind of continuation upwards. But like, look at where these things started, right? So here was, the middle of July. This is where that last Fed meeting was. It pumped from here all the way up. This was a nice big pump right here. It was great. So the September meeting was a little bit different. It pumped up a little bit, but it didn't go too far. It actually had to kind of consolidate for a while before it started to drift up. And people are thinking, okay, the market has priced in some movement in the future. Hey, Lucifer, what's up? Thanks for coming in. Glad to have you in here. So the market is thinking about what's the economy going to look like in the future. The market isn't looking at right now or in the next couple of weeks. It's looking at 6 months to a year ahead. So if you think about what is the Fed's plan for 6 months to a year ahead, the Fed's plan is we're going to be in that pause range, maybe starting to come down, right? A year from now, that rate, whatever rate we end up going to, which could be north of 5%. I mean, people are talking about, it was going to be 3% initially, maybe even, actually, I think it was going to be like 1.8 to 2%. And then it was 3, then it was 4, now it's 5, or then it was 5, now it's above 5, because that was the thing that scared the market during the Fed meeting, was the fact that they changed their projections a little bit. They made them slightly more hawkish. So the market is repricing that in. Like all this movement was repricing of the market. It was basically the way to say, okay, the Fed has said this is what the conditions are going to be in the 6 months to a year time frame. So what do we do to price for that? Well, money's going to be more expensive to borrow, so we can't be up here. This is way too expensive if you have to pay more to borrow money. So it's going to have to come down. And, these, you kind of have to ignore these because these are squeezes, because people think it's going to be worse than it is, and it squeezes, right? And then this was earnings right here. Earnings were fine, okay? That was the thing. The earnings were actually fine, but the projections, what people thought was going to happen, was lower. And that's what we keep having. We keep having a crisis of mind, basically. We keep thinking that it's going to go lower because all these companies and all these economists are projecting that it's going to go lower. That doesn't necessarily mean that's actually going to happen. That's just what they think. But because the companies were playing it safe and they said, all right, well, we want to downgrade our projections, because that's what the market goes on when a company reports. It's like, okay, how much money are you going to make in the future? That's what I want to know. Did you do at least okay now, somewhere within an acceptable range? And what do you think you're going to do in the future? And they'll go like, okay, they think they're going to be making this much in the future. That means I can buy the stock up to this level because that is the level at which it equals what they think they're going to get. And every time the Fed comes in and says we're going to tighten rates a little more, you have to drop that level on the market a little bit. Not just individual companies, because there's the individual companies and then there's the collection of all the companies. There's the collection of all their estimates. And that's what the market is trading on. Because if you think about the SPX, it's basically just a bunch of companies stuck together, right? So you're kind of taking the average of all those companies and putting it into one thing. And what is that average going to be at if the Fed makes money this expensive? All right. And then if the Fed changes that, what is that average going to be after that? So right now we're in another repricing. I don't think it's going to be as bad as some of the other repricings because they basically kept everything else in line. They just said, all right, maybe the peak rate is going to be higher. We don't have a concrete number for the peak rate. So the most expensive that money could be in their projections is open. Right? They used to say, all right, this is the peak, 4.75, 5, that's the peak. Now they're saying maybe over 5. So we really don't know how expensive money is going to be, which means investors and traders are going to be a little bit more apprehensive about definitively picking a price for the overall market. That's what we're getting right now. So we got some people coming in and saying, like, I'm not sure what it's going to be. It's definitely going to be lower. We already had this pump when we kind of hit a bottom here, so it has to have a drop to kind of consolidate that. You're going to always have overreaction no matter which direction you go. If you're going up, there'll be an overreaction to the upside, which means there's probably going to be a retracement, especially if Jerome Powell comes out and says, hey, we need you to not do that. And that's really what he was doing. The data, we knew the data, right? Then the rates come out at 11 o'clock and their projections come out, I think, sometime around that same time. And they might even release more while he's talking. I really don't know the specifics of it. But once they put all their data out and Jerome Powell says, like, all right, here's our dot plot. This is what we're going to do. In fact, I don't think they're going to have a new dot plot until the next Fed meeting, because the next Fed meeting has the summary of economic projections, which this one didn't. But they basically just said, our next summary is probably going to be higher. And that's what we're waiting for now, is we're waiting for their next summary in December, which will be the last one of the year. So we've got an election coming up. Tuesday, I believe, is the last day. There might even be some lagging. I think maybe until the 10th. So between the 8th and the 10th is when all this stuff is going to go down. So once this week is over, we should hopefully have results. I mean, there's always like laggards, and there's probably going to be craziness because that's what elections are now. Nobody can take anything seriously. They have to go into the hyperbole and make everything crazy and all that. They can't just like vote and forget about it. You know, they got to go to war about everything, no matter what side you're on. So this is going to drag on because idiots are idiots and they can't calm down. They can't look at reality and just see like, okay, things are okay. We don't have to freak out so much and make things not okay because we're freaking out. But anyway, so sidestep that. We got an election. That's going to be this next week. That's the next big thing. We're finishing up earnings. That's also kind of winding down at the end of this week. We're going to have a bunch of companies report, and then it kind of trails off. There are some companies that I'm going to be watching for the next month, basically, but most of the big companies are going to be done after this next week, which means the pressure from earnings is going to relieve a little bit. So we have this last Fed meeting out of the way. They already kind of told us what's up. We have most of the earnings out of the way. After this week, they're basically going to be done, except for a few more. The election is going to be done this week, which is another big thing we've been waiting for. So after these events, markets tend to rally. You put all of those together, you could get a pretty big rally because of the relief. Regardless of where the market is going to be later based on the fundamentals, I think there's still going to be a relief rally at some point. And I think part of the reason it didn't pump so much during the Fed meeting was, one, the hawkishness, and two, because the election's coming up. And elections are extremely important to the market because if a different candidate comes in, then money moves around. If the same candidate stays, then money can stay. Like, it depends upon what's going on. And a lot of these candidates have the same interests. They're working for the same people. They take donations from the same people. They're doing, giving favors to their buddies or whatever, but there are some differences. So once that's over, that's basically a worry out of the mind of investors. So that's free reign right there. We still have everything else, though. We still have the end of the year, right? Is it going to be a tax loss selling year? Are we going to get a nice dump at the end of the year like I'm really hoping for? I don't know. I'm unsure of that. Like, I think because we're down, if you just look at the whole year, like the idea of a tax loss selling year is that stuff that's down at the end of the year and is hurting people's positions can be sold to offset the gains in other areas. That's a good way to not have to pay as many taxes on things that you've made, because depending upon how much money you have, taxes can be pretty extreme. They can actually really affect what traders do. So you have to take that into account when you're thinking about what's the market going to do. We've also got buybacks. I believe either next year or the year after that, buybacks are going to be taxed in a different way. So there there is incentive for companies to get their buybacks done this year. So that's why I think there could be a rally. We've got the Santa Claus rally is a possibility. There was a statistic that said most of the time after an election, there's a Santa Claus rally. And the fact that we've had all this downward movement means prices are looking good. I mean, I jump into the market every day and I think, oh, this looks so, I just want to buy everything. Everything looks so good right now. Everybody's afraid and they're all getting out of the market and they're down, their portfolio's hurting. Yeah, well, mine is too. But guess what? This is when you have to buy. Everything's looking really good right now. I've been waiting like 2 years for this to happen again. And even before that, prices were doing the same thing. Remember I was showing you how it's just up, up, up most of the time? If you're in the markets long enough, this is what you're going to see. Yeah, you'll see some years where it's volatile like this. Like 2018 was the only down year that I've ever experienced up until now. Like, it's going to be very hard for this to not end as down year. Even if we get a nice rally, I don't think it's going to pass all-time highs until a bunch of stuff is lifted, because there's still the issue with Ukraine. Shipping is improving, but it's still an issue there. Commodity prices are still high. Energy prices are still high. There are reasons why it's probably not going to rally. And the big one is the Fed. The Fed is holding things down. They've worked on the psychology of people, like regardless of what they're doing in physical terms, because they work on demand, right? They've made money a little bit more difficult, or actually a lot more difficult to afford for certain individuals, which means they're not going to have the cash to continuously pump prices up in the market. The reason prices go up is because people have money and they get into a bidding war against each other. So they bid the prices of everything up. The stuff, corn that's used to make like everything, every food item now, that gets bid up, right? Wheat gets bid up, rice gets bid up, coffee gets bid up. And then energy is the same way. Energy is traded on the stock market. There's so much that goes on based on the markets that it affects everything we do. So the prices that you see in the grocery store are directly linked to the companies that are in the stock market and the goods that they're buying on the commodities market. So there's so much that can change. And this week was a difficult week for me because I had that loss. This is my first loss on a Fed meeting. So I went in on Wednesday with the thesis that I wanted to catch a rip. And I missed it because the rip happened before I entered. And normally, if you're waiting for something like that and you see it, but you're not in, you don't want to try to get another leg up from it. If the move happens and you missed it, don't try to chase it. I tried to chase it. I thought, okay, there's so much negativity that I could see a huge squeeze, even though it would be temporary in my mind, at least. I could still see it happening. So I was ready to jump in. We got that nice move. I was up a little bit, actually. I was up like $80 a contract for a little while, and I thought right then, I was like, I don't like the way this is kind of stalling. I should probably get out. But I didn't, and it went down and down and down and down. But then it started to rebound, and I was almost at break even, and I thought I should get out. And I didn't. I just let it go. This is what happens. You get in denial for a while, right? Because I've done so well on these trades, and every single time it's gone through, it's worked, right? And there have been some times where it was a little sketchy, but then it ended up going afterwards. So I just trained myself to kind of let that feeling in your stomach not get to you. Just write it out. But this was not the time, because I wasn't thinking clearly. I was thinking, all right, I need to get this move. That was what I wanted. I wanted the move. It wasn't about the actual trade. I wasn't thinking like, are the dynamics of the trade good? I was thinking, I want the move. I want the money. Give me the money. That's what I did. I jumped in. I should not have jumped in. So let's take a look at that so we can actually get a better idea of what was going on. We're going to switch to the Qs because that's what I was trading. The NASDAQ is extremely beat up. It's extremely volatile. It's a great place to catch some volatility if that's what you're looking for, but it's not always going to work for you. This was the day of the actual Fed meeting. So it came in, it was drifting down all day. Towards the bottom, I thought, I should grab some calls. This has been looking good. It's actually been in one direction. And usually on the days when something's going to happen and you know it's going to happen, there's not a huge move one way or the other. It kind of follows VWAP because people don't want to get too extended in one direction and then get crushed if it goes the other way. So right here, as it was drifting down, I thought, man, there's a good chance that it goes right back up to VWAP even before the meeting started. And what happened? It went right back up to VWAP, just like I thought. But I didn't get in because I was thinking, I'm going to wait. Then the rates came out, and we got this nice pump all the way up to here right away. It said 75 basis points. Traders went off to the races. They were happy. But that was basically the peak. It did go a little bit over that. It basically hit this, and then it kind of drifted down for a while, and it drifted back up. And then Jerome Powell started talking, and it kind of popped a tiny bit. I was in right around there when it popped, and I was up a little bit. and then it just fell for the rest of the day. I mean, even though there was volatility on the way down, it was basically a straight line down. These are 30-minute or 20-minute candles, so you can see every 20 minutes it was a little bit lower. And I got out somewhere down in here, I think, maybe this candle or this candle. Basically, I was in denial for a while and then, took my loss. But that's what happens. I mean, you got to think clearly about these things. I should have just not traded. But I'm at the point now where I've been using a bunch of my cash to buy things because it's been going down. I'm running out of bullets. I'm running out of free cash. It's hard to go execute trades. So I was like, all right, I'm going to get a little bit more free cash. Well, this time I ate away like 20, 30%. I think it was about 30% of my free cash, which is gut wrenching right now. It was very difficult to get over, but hey, it is what it is. But that was the thing. I got the move beforehand and I tried to catch the next leg up and I paid for it. That's the lesson you should learn from all of that. From my pain right here. If you're expecting a move and you get the move before you're in, don't try to catch another leg. Even though you think it is possible that another leg could happen. And if you don't do it and it does happen, don't get mad at yourself. Just think that's much better than having the thing that happened to me happen to you. It's so much easier to just skip the move and wait till next time. Because if I had done that, yeah, I wouldn't have made any money, but I wouldn't have lost what I lost. So I'm down because I was chasing. I got FOMO. I wanted to get that money. I got a little overconfident. And when I knew things weren't going well, I didn't listen to my gut. I said, I'm just going to wait this out. I'm just going to wait this out. Because if I get out now, either break even or down a little bit, I'm going to be pissed when it flies. Well, it didn't fly. If I had gotten out right away when I thought, I would have not only been up, but then I would have been extremely right about it, and I could have been bragging. But in this case, I can't be, because I got crushed, and that's what happens. But that's okay. I've done really well this year, so I actually really wanted to show a bad trade on stream. Every single trade I've made for the entire year, going all the way back to March, has been a successful trade. And some of them, like the second trade I made, was an amazing trade. It was one of the best trades I've ever made. The other ones were decent, but this one was terrible. So it was about time I got mine, and I did. And that's what I wanted to talk about today, was that specific trade right there. So, again, the point is, don't go for the move, or don't try to get a second leg of the move if the move you're expecting already happened. That's the big one right there. Now, everybody's got their own trading style. Everyone's got their own advice. If you go online and you just look this stuff up, you're going to find so many different opinions. You're going to find all these technical analysis traders. You're going to find fundamental traders. They're all going to be full of shit, all right? Everybody's full of shit. I am. Everyone else is. I'm just sitting here blabbing, giving you my opinion. That's what it is. Like, this isn't financial advice. This is just my opinion. This is just me venting. People in my life didn't want to hear me talk about this stuff anymore, so I wanted to come on here and talk to people that are actually interested. And that's what I'm doing right now. Hopefully, people care. All right, moving on. So, rough week. We had the Fed meeting. The Fed said 75. I didn't even pull up my notes. I need to pull up my notes. It's going to take 80 years to open that thing because, I don't know, for whatever reason, that program just doesn't work very well. We had some economic data, too. There's been a lot, actually, since the last meeting or since the last broadcast. And next broadcast is going to kind of be a lower... I'm going to be laying low a little bit because after that, we're going to have another Fed meeting, and then we're going to have this possibly Santa Claus rally. So I'm just going to sit and wait with my tiny amount of cash, hoping I can catch a good trade to make some of that back. But I don't want to think about making the money back. I just want to say, this is where I am now. I'm going to let it go and move on from there. So that's what I need to do, is just kind of let this stuff go. That's what I've been trying to do throughout the week. And, I have been. It hasn't really gotten to me the way some of the other losses that I've had in the past had, because I knew going into it that it was dumb and there was a bunch of risk to it. And I knew if it does happen, then I have to be okay with it. So, all right. So finally got my notes open. So I'm going to go over that, and then we'll see if anybody's got any stocks or anything. Throw them into the chat. We'll take a look at them. Just because I had a down week doesn't mean we can't talk about other good stuff. The thing I like is the prices. I love the prices. So one thing I have been doing is still adding to my long-term position. I'm buying shares and I'm buying leaps. I'm buying 2025s if I can, but 2024s work too, because I have a feeling the market's going to flip around. Because there was actually a study that said before the economic data hits a bottom, the stock market has already been rallying for like 4 or 5 months. So basically the stock market finds a time about, let's call it like 4 to 6 months before the actual bottom of everything else. Because like I said, the stock market is forward looking. So you can't judge based on today. You have to judge based on the future. And if we're getting to a point where the rate pause look like it might be winding down, then the market will think, hey, we can rally now. So because the rates are going to go up, they're going to pause for a while, and when everything looks better, based on the data, not based on any time period or time figure, then they're going to start bringing things down. And that's when the market's going to be extremely happy. But before that day comes, it's probably going to start rallying, because the other thing they're going to do is they're going to tell you in advance that this is what happens, because the Fed tells you exactly what they're going to do way in advance so you can get ready for it. And what's funny is people still get pissed off. In fact, I have this little meme sitting around over here, if I can find it real quick, that was talking about exactly that, because this is what they do. They basically come in, they say they're going to do something, and then people get mad about it. All right, here we go. So there's this right here. Let me full screen this thing. Right? It's like March 2022. We were wrong about inflation and need to start raising rates. Expect some pain and 4 to 5% Fed funds rate by the end of the year. And now there's people like, oh my God, he did exactly what he said he was going to do. Worst Fed chair ever. Down 90%. Yes, this is what's happening to people. People don't understand. When the Fed comes in and says that they're going to start doing stuff, it will affect the market. There's a phrase, don't fight the Fed, right? This will happen. If you try to go against what the Fed says, you're going to get hurt. Why? Because they control the money. Okay, they control the money supply. There's no reason why they can't affect this stuff. When they say they work on demand, they work on people's ability to buy things. They work on their ability to have demand. Not just work on demand itself, but work on the psychology of people so that they will think, oh, I don't want to buy that, or oh, I do want to buy that. When the Fed lets things rip, then people can come in and buy whatever they want. But when the Fed is locking things down, it's going to be a limited amount of people that are able to actually get in there and trade. So you don't want to go too crazy with it until this period is over. And like I said, the market will start rallying before that point. So you have to be ready for that. And people aren't going to be. They're not going to believe the rally. See, that I've been through this multiple times. What always happens is you don't see the huge drop coming. You think it's going to be a small drop because you never see a big one. You always see these little drops and you don't get in on them and you miss them. So you go, fine. When I get a nice big drop, I'm actually going to get in on some stuff. So then you finally get that drop and you get in on some stuff, but you don't realize that it's still going down. And it's going to continue to go down for a while. And people aren't ready for that. So they get out and they leave the market forever. Or not really forever. They leave it until the next bull market comes and everybody else is making money around them. And then they got to jump in right at the end and lose. That's just what happens, right? You got to... I mean, that's life. It kind of happens with everything. But if you know that about yourself, you can kind of control it and you can kind of relax. So the Fed said that. People are mad about it. They're doing exactly what they said. And the market knows that. The quote, smart money. I really hate that term. I'm so tired of hearing that. Oh, the smart money. What is the smart money? When you look into these things and say they're checking the smart money, it's like, oh, there was a big trade on this one thing, so that's the smart money. So basically anybody that has a lot of money is the smart money. Well, guess what? That's not true. There are people with a lot of money that don't know anything. There are a lot of those people. So that just because it's a big trade doesn't mean it's the smart money, right? So I hate those services like, oh, we got the smart money. We're telling what the smart money's going to do. Yeah, well, guess what? I have the same info. It's called time and sales. You jackasses, calm down. Jeez, I can see that there was a big trade there. Ooh, good job. What do? You got some secret, people are going to buy your $1,000 course because you're going to teach them how to look at time and sales? Come the fuck on. Anyway, so there's a little rant about that. Let me get back to my paper here. We got the elections coming up. We said that's the big one next week. We could have a relief rally after that just because there is so much uncertainty. Fingers crossed for cannabis. I don't think anything's going to happen. I mean, there are going to be some legalizations in some states, but usually when that happens, the market dumps. It's a buy the rumor, sell the news event. Every time in cannabis. Cannabis does not continue to go after things pass. Why? Because it's still federally illegal. So it doesn't matter, right? It's legal in Canada and some other places, so it's not like the industry is completely dead. You can actually see all these companies, they're making sales. And it is legal in different ways in the U.S., like locally. It's just not legal federally. So that keeps keeps businesses, I should say, from being able to get loans to increase, like the cannabis industry can't get loans properly because they're a Schedule I drug and the federal government says it's evil and bad and all that stuff. That is eventually going to change. But until then, it doesn't really matter from a money side. So the big money's not going to touch it until it's able to run free, right? But cannabis, it could look good. I mean, if there is some miracle and it does pass, great, but I don't think it's going to. I really, really don't think it's going to. So anyway, we've got the election. There could be some relief after that, but we're still waiting for something else. The next one is the CPI. All right, the next CPI comes out on the 10th. So is that Thursday? I have to see really quick. Oh, I don't have a thing over there, but yeah, I think it's Thursday because the 8th should be a Tuesday. But so next week the CPI is coming out, and that's what we're waiting for. Is like, what is inflation going to be this time? We want to see if it's higher, lower, or in line. And let me tell you this: if you're waiting for a big reaction on the market, that's the day. Whatever the CPI says will cause a big reaction. If it's higher, there's going to be a huge dump. I mean, there's just no way around that. People are going to be super scared if inflation comes in higher. If it comes in lower, we could have a rally. I'm more confident in a dump than a rally on either scenario, right? If we have a huge CPI number like way above what it's supposed to be, that's a no-brainer. It's definitely going to dump. But on a lower number, it may or may not rally. Now, if the number comes in a lot lower, then yes, definitely there's going to be a rally. But if it's just a little bit lower, I'm not sure about that. Oh, hey, sorry, I haven't been paying attention to chat, so let me get in there. Salome Fishby, how about ETH? You know where I'm buying and selling? Yeah, I looked at that earlier, but I'm doing so much stuff, I don't remember the exact price levels. I know you got a nice little trade in there. Actually, let me pull up ETH real quick just so we can take a look at it. Not surprising, we had a gap down in the futures for the S&P 500, so crypto's going to follow it. I mean, since so many of those stocks own crypto, and that's like some of the big money in there. It's just the way it's going to go. If you got a nice little drop here, is it a place to buy in and get another, like, if you're looking for like a dip buy and then a sell when it goes up or something like that? I'm not sure about that right now. We have to see where the repricing of everything is going to settle. So crypto, the stock market, whatever, it's all in the repricing mode. And this gap right here in the futures tells you that. I mean, let me zoom in over here on this chart, because we've got the S&P futures. So you can see there was a gap here. These are 30-minute candles. We basically had an hour of movement so far, and it gapped down. ETH is following it in the exact same way because it's part of the market too. And that's telling me that on Monday we could have a move. And I don't know if I'm guessing it's going to be down. I think the market is probably going to move down a little bit. I can't tell you on what day we're going to have downward moves and upward moves, because there is always an upward move during a downward trend. But I think in general, over the next week or two, or at least until the election, we're going to have some downward movement. Or you know what? Let me change that. Since the election is happening on Tuesday, and which means we'll probably have the results like Wednesday, Thursday, the market will probably stay somewhat centered. It'll probably trade sideways. That doesn't mean it's going to be perfectly sideways. It could be extremely up one day and extremely down another day. But overall, it's probably going to stay in a range until we have that relief. So let's see. You sold a little around 1650, and I want to buy back in, but I'm not sure if I should target 1450 or 1550 or lower. So let's see. You said you sold around 1650. Oh man, you got it like right over here. So I'm guessing you sold on like a Friday or something like that, maybe Saturday, whenever it was up here. Because there was trading going on the weekend, but since this is the futures, it's not going to show you that. It's only going to show you like the close on what is that, Friday, Saturday, something like that, and then the open today on Sunday. So we're not going to see whatever was happening in between there with the crypto market. But whatever, regardless of what happened to it, the market pulled it right here. So it could have been going up the whole time and it would have been pulled down. I know some cryptocurrencies were going up because I was getting messages on my phone. Like Dogecoin pumped and then dropped. It's like, oh, Dogecoin went to 13 cents and then to 12 cents. Big deal. I don't care about Doge right now. It's just pumping because of the Elon Twitter thing. Like, that's anytime something happens with Elon, there's going to be some Doge movement. Just because he made those comments a while ago and he owns some Doge. He likes Doge. Right, he likes it because he thinks it's funny. Probably he doesn't. I mean, I haven't really listened to what his thoughts are on it, but because he's an influential figure and he's involved with it, there's going to be movement in Doge when there's stuff with Elon. If there's something bad with Elon Musk, Doge is going to drop. If there's something good with Elon Musk, Doge is going to pump, and there'll be corrections after that because it still has its own overhead. It still has its own environment to live in. But the people that follow Elon Musk and think about Doge tied in with him are going to make those reactions in the short term. So anyway, the point is crypto came down a little bit. You're not sure if you should sell or should get in at 1450, 1550 or lower. See, that's a tough one. So I think the market's going to continue to trend down a little bit. What it could go to, I'm not sure. Let's back up a little bit and see what we have recently as far as a target. Okay, so we've had a low down here at 994. When was that? That was in July. So yeah, we had the market come down after all the earnings, and then we finally had the Fed kind of pump it back over here. So you have a bottom in the 900s. Is it going to trend all the way back down to that area? I'm not sure, but I do like this range that it was staying in right here for quite a while, I do like that as a possible target. We have the point of we're basically sitting at the point of control right now, and the point of control is just the area at which most people's average is sitting. So your average is basically when you buy or sell a stock, you average all the buys together, and then you see what your average cost is per share. And the average cost of most people is right around this 1,500 level. So the market could pull this down a little bit, and it could trend a little bit. It does have support in the 1,200s, because if you look at this volume right here, it's actually sticking out quite a bit. So as far as an area that's difficult to get below, this. And look at where it lines up with. Right here. Right? So there are a bunch of people in right here. There are a bunch of people in right here. The market is kind of the dictator right now, because the market is saying, all right, we've got some repricing to do, which means everything's going to follow it. So I can see it trending down somewhere in this range. And you don't know if you want to get 15 or 14. Well, that's going to have to be up to you. Like it depends upon how much money you have and how much risk you want to take on. If you feel like it might go, you could set your orders a little bit higher. But I would guess that we're going to have to see some consolidation for a while. So I'm thinking we're probably going to see a little bit of a drift. And then my guess would be in between these two levels. But this would be a good place for it to kind of hang out again. So like that 13, that 12 area. The way I usually do stuff like that is I put small buy orders in up at these. If you think like 15, 14 is where you want to hang out, we've got some moving averages right here. These moving averages are all sort of converging on this same area, which is like this 14 to 1,500 area, it looks like, or 14 to 1450. So I like that as an area where it can come down to settle. I like this as an area down here because it was kind of trading in this for an entire contract cycle. And actually, this is interesting. Look at where it traded. So these red lines are the major contract cycles. So you can see when the new contract cycle came in, it hit its range and it stayed in there until the very first candle of the next contract cycle. And that's what seems to happen, is contract cycles have their own patterns, and then when the next one comes up, it becomes a different thing. And that's because the people that buy into these things are also hedging their bets with stock. So people are like they're buying stock so that they can make more money selling calls on that stock. And if they buy enough, then it's kind of a self-fulfilling prophecy, and it moves the stock up. They're able to sell at a gain, plus keep the premium. So they're happy with that. And the next contract cycle, they use that money to buy something different. So they end up selling their hedges and buying something else, which means whatever they sell will go down, whenever they buy goes up. So you'll see these pops change. And it almost looks like this has kind of been the range. So I could also see it sort of sitting here too. My guess is that we're not going to have a huge pop. If we have a rally, it'll probably get crushed. And I mean, I'm looking at ETH right now. I would be thinking about the total market. But what I do like about ETH is it's very clear with its ranges. When it comes down to an area, it wants to sit in that area for quite a while. Like, I think crypto is a buying opportunity if you just buy little bits here and there right now because of where it is. I mean, look at where ETH was not that long ago. In 2021, it was up at $4,000. And now if you look at this past, like, I don't know, 5-6 months, whatever it is, we've been in this range right here the whole time. There was a little bit of a peak, but it kind of came back down, and it's towards the top of it right now. So the market wants to break out. Like, I can see when it gets repriced, there being a rally. But I do think that there's going to be downward motion. So my guess would be put in like small orders at the higher end of where you think it's going to go, and then bigger orders as you get lower. And that has to be your own, you have to be confident in what you're doing and be okay with that, because I'm not going to tell you what to buy. I can't tell you what to buy. That's all up to you. But it does look like if the market goes down a little bit, this would be a good settling point right here in that 13, kind of like 12 area, I would say, at the low end. Now, if we have a huge crash, then yeah, we can see it return back to these lows in 900, stuff like that. Oh, wait, the futures started then. We didn't have any futures for ETH before that. That's why I can't go back. Oh, dang. Well, that's too bad. Let me see. Let's look at Bitcoin, because I mean that's a better proxy for the actual market anyway. Plus, ETH is going to follow Bitcoin, so it really doesn't matter. During the pandemic drop, it went to about 4,000. I remember that low day because my account was locked. I had money that I couldn't use to buy at the lowest price Bitcoin has been for a long time. But I'm not, still mad about that or anything. But you can see that when it really panicked, we came down here. Now this area right here was when a bunch of new people got in. That's why these moving averages went up so much. That's why this went up so much, because we have so many new people coming back in, right? They finally, after the 2017 crash, which you don't really see right here, or I should say the 2018 crash, a bunch of people got out, didn't want to deal with it anymore, and we kind of had that final little death spiral right here where it went down to the low 3,000s. I mean, I even got out at that point because like I bought in right here and I was hurting right there and I didn't know what I was doing. But that was a good place to buy in. I mean, even though it kind of stagnated in this like 8 to 12K range for a while, we eventually had the pandemic. We had a breakout. We had an extreme mania, I guess a blow off top, if you want to call it that, right here. And then it's been crashing ever since. So the fact that we had this nice blow off top and this recovery just tells me like, okay, so maybe you buy some ETH at 1,500, maybe you buy it at 12, maybe you buy it even lower than that, whatever the number is. In the long run, it's not going to be that big of a deal. If you're trying to trade this or like swing trade it in the short term, I mean, that's going to be a little bit riskier because we'll probably have a pop at some point, but who knows when. I mean, it's so up in the air right now. The election, the Santa Claus rally, the last Fed meeting, the trailing off of earnings. There's just so much in there that could cause movement in either direction, which is why I'm sad that I'm so low on cash because I just want to buy. Like, I don't want to try to do these trades anymore. Like, I'm at the point where it's just things are so crazy that all I want to do is add to the future and know that things are going to drop in the present. I'm okay with that. I'm going to buy stuff. It's going to be down the next day. Because you know what happens if you don't buy it? Eventually it starts going up and then you don't want to chase it and you miss it. That's what I did during this whole pump. I mean, I sold almost all of my crypto in here. Like, I was buying in here all the way up. And once, it kind of stopped here for a while and it looked like it was peaking out, I dumped here. And then when it was coming down back here, I thought I was doing really well. But I didn't buy in the way I had before. I just kind of bought little bits here and there and it didn't really do anything. And by the time, and then when it pumped again and it got up to like 20K or whatever it was, its old high, I dumped most of it then. The rest, so I dumped most of it here and then I dumped the second portion of it here. So I rode this with very little. Like if I rode this with everything I bought in here, I would have made so much money. Even if I had sold here, I still would have made a bunch of money. But because my mindset was on the previous high, I was stuck in this era. The new people weren't stuck in this era. They were in this new era right here where things were moving. I was stuck back there. So when I got that to that point and it kind of stuttered a little bit, I thought, all right, it's time to get out. I saw what happened before. I don't want that to happen again. Well, this was a different scenario. And actually look at that. Look at where it has returned to, right? This was the area that kind of shot the blow off top off. This is where things got out of control right here. Like this is not unhealthy. This part right here where we had the crashes and the recoveries and all that. Yes, I mean, the difference between $3,000 per Bitcoin and $14,000 for Bitcoin is quite a bit. But if you scale that up here, it's nowhere near this. I mean, this is insane. Talk about 14K to 65K, 69K. I mean, that's a huge jump. So the fact that it's come back down here into this area is telling you like there are a lot of people that bought in, right? It should be going lower. The market has been going lower, but it is not. It's kind of bottoming. So I think this is a good area. If we do get a little drop right here where this volume is thin, I can see, this area of support down here actually holding pretty well, unless, the world's ending, which I don't think the world is going to end. So there's probably going to be some downward movement. It's not going to be clean because we're in such a high volatility time. So you can kind of expect that things are going to be moving around. Buy orders for stuff like that. It's better to have them, light and then heavier as it goes down more, as long as you believe in it. And also know that it might hit your bottom order and keep going. And you could just be sitting there in pain for months or even years. You have to know that that's a possibility. I don't think it's going to be that long. I honestly think that a rally is going to happen as soon as we get past a lot of this, as soon as we get a good inflation number, which actually might be next year because inflation numbers are compared to the previous year's numbers. So it's high based on last year, but next year it's going to be a much smaller gap because it's going to be like, is it going to be 8% above what this year's reading is? I highly doubt that, especially with the Fed crushing things down. So we might even see decreases, which would be extremely bullish. So if we start seeing numbers coming down, that's going to be the sign to rally. And here's the thing about that. When we start seeing those numbers and we start seeing mini rallies, there are going to be way more bears. The bears are going to double down because they've been winning. Like the bears are basically drunk with power at this point because if they've been holding on the whole time, even though there have been some pumps, they are up huge. And they get to spout their rhetoric about how the dollar's going to go under and everybody's going to die and blah, 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 blah. We've heard it all before. It's the same stuff. And eventually it's going to turn around. They're not going to believe it. So that's why I think when we start getting these numbers that come in positive, they're going to say, oh, but what about this? But what about this? Oh, that doesn't mean anything, blah, blah, blah. Well, it doesn't matter if it doesn't mean anything because the stock market is based on people's emotions. It's based on what people think is going to happen, not what's actually happening. So being a stock market trader, like being a really smart data-driven person is helpful, but it can also get you lost because you can get so focused on specific data points. And that's what I see in these bearish videos. It's just like data point this, data point that. In fact, here, I have another, I have a picture on here, a couple of pictures. Oh, Salome Fishby, sorry, I missed what, I missed what you were saying here. So you think it's, I think it's going below 1300 or above 17 without a major catalyst. You don't see it doing that. And that's the range I'm trying to trade under until another major rally or crash. So you can do that. Like right now, we're clearly in a range. If I go back to Ethereum, actually, I really like the fact that it stays cleanly in these ranges that it sits in. You know, this is a very clean support and resistance profile right here. Because look at that. I mean, the next one sits right on top of it. Like this is, you usually don't see that very well, and that just happens to be at the point of control. So you could like trade this range for a while. I think, you know, coming back to this point of control is extremely likely, which was that like 1200-ish area. But we'll have to see. I mean, news can change anything. Russia could come out and be like, all right, we're done. We're just kidding. See you later. I mean, that's not going to happen. But if it does, the market would go crazy over that. You know, or we could get one really good inflation number because it's actually working in one area, you know. Maybe core inflation's down, maybe headline inflation's down, whatever it is. Something could move the market quite a bit and we could rally. But most likely it's going to be down. And honestly, what I think people want is they want it to be down. Because the more people I talk to, like even though they're in pain, they still like the fact that it's down and they want an opportunity to buy even more. And that's what we'll get. But once the buying starts, like the way people are thinking about the market right now, there are a bunch of piranhas ready to be released into the pool, right? There's a bunch of people, the bears are in the pool right now. They think they're cool. They've kicked all the bulls out. They're sitting there celebrating, but there's a bunch of piranhas ready to fall right into that tank. And like once the piranhas are released, it doesn't take long for them to go crazy. That's what we're going to get going here soon. Probably. When I say soon, I mean months. So probably like early to mid next year, I would imagine, because 6 months to a year after that is when things should be clearing up, according to the projections. So whether they're clearing up or not, as long as there's no major catalyst, the market is just going to treat that as fact. The market is going to say like, okay, the projections say this is when it's going to happen, so this is what we're going to plan for. That's what they do. That's why we get these huge swings in the market, because people plan on things being a specific way, and then when they're not, they have to adjust quickly. Because, you know, 9 times out of 10, the market goes to those projections. You get all this hyperbole about how it's not going to do that. It's going to do something different. And then those traders get crushed. So the ones that are just diligent and they know what they're doing, they're looking at history, they'll see the market move roughly in line with what you think it should based on, you know, specific fundamental data points. Most of the time it pays off to not be a bear and just kind of let your things float up with everything else. Why? Because they're pumping money into the market. Because of inflation, assets are going to go up. Stocks are assets, bonds are assets. Anything you own is an asset. So, all right, thanks for the info. I set my buy orders every other Sunday. Oh, okay. There you go. Setting them buy orders ready to when we're streaming here. That way you can update with everything else. Yeah, so, I mean, your projections are kind of in line with mine. You're thinking in between that 1,300 and 1,700 range for Ethereum. I think that's good, too, until we get a catalyst to go higher. That catalyst could happen any day, but it's probably not going to be for a while. Like I said, the rest of the year is most likely going to be down. But because people want to get deals at the end of the year, there's a good chance that there's going to be a Santa Claus rally, which is what the projections say when there's an election anyway. So I'm just kind of counting on that. If it doesn't happen, that's fine. That's just a better buying opportunity. But if it does, like I'm looking at mid-December to really try to get in on some lows if we can. You know, so we'll have to see how that goes. Probably after the Fed meeting, whatever, I forget what date that is in December, but it's in December, and that's kind of the last catalyst besides Christmas until the next year. So we talked about crypto, we talked about my terrible trade, we talked about the market, and I think that it's going to be dropping a little bit. We're going to see some volatility, but it's probably going to be trending down because of the futures. So we've had a little bit of volatility already since I've been talking. It opened down, kind of pumped up a little bit in return. So look at that. We've recovered some ground. And a lot of time there's a big reaction. It'll kind of drift back towards the median. That's a normal thing. So this gap may mean nothing, but it did say that orders stacked up. People were a little bearish and they were afraid and wanted to get out. So they did. Now, other traders aren't that confident. So other in that direction. Some of them think it's probably going to pop. That's why I think we're going to drift down. We're not going to have like a big slam down the way some people think. Just because that's not what usually happens, and we have a lot more info than we had just a little while ago. So we'll probably drift down. That's the thing. So what did we get coming out? Some of the notes. Unemployment is now at 3.7%. The estimates were at 3.6%, and the prior was 3.5%. So unemployment has gone up a little bit. Not really meaningfully. It's still in that same range, but it is above estimates technically. So that is one thing. I mean, that shows you that this is working, right? It doesn't happen overnight. Like the dropping rates and quantitative tightening, raising rates and quantitative tightening and all that stuff, they don't take effect right away. You have to watch them slowly over time. And what you've seen is a bunch of companies saying, we're going to pause our hiring, or we're not going to hire at all. Or some people just reducing it, some people are stopping it, whatever it is. I keep hearing story after story about that. Different business. This business is doing it. This business is doing it. So I know something's happening. But the unemployment numbers aren't really reflecting a huge drop. Like I thought it was going to be a little more based on all the stories that I was hearing. But you never really know because some of that stuff is circulated multiple times and it might be the same ones. Unemployment has gone up a little bit. So there are some jobs being lost because of everything going up. That is something. And we don't want it to go up massively. Like they don't want employment to be at 10%. They want they don't want unemployment to be at 10%. They want it to be at like 5%. Because if you think about historically, 6% unemployment is not terrible. I mean, like, let's say between 4 and 6 is a good range. 3 is really good. We haven't had 3 very often. So even though we've gone up a little bit, we're still well within this nice range, and so the Fed wants to see that go down a little bit because more people have jobs, it's more money, they can compete on things, they can bid up stuff more. There's competition for workers, which means wages can go faster, which means there's even more money in the system. So it's not like the Fed wants to hurt people because they don't like people, they're trying to keep them down. There's all this talk like, oh, it's elite. I mean, it might be, I don't know, maybe you don't know what's in somebody's head, but basically they're trying to say like, we need people's ability to make prices go up. We need to limit people's ability to make prices go up. And one way to do that, unfortunately, is to crush the job market a little bit, which is kind of what they're doing. So yeah, it's up a little bit, but it's still very low. It's probably not going to move that quickly until things really get going with this. So I'm thinking like maybe next year, because people talking about, oh, next year's the definite recession. Yeah, maybe. I can definitely see that happening. It's a possibility, but I've been burned by bearish predictions so much that I'm kind of like, I'm more apt to believe a bullish prediction than a bearish one at this point, just because that's what I've seen my entire trading career. However, interest rates are higher than I've seen them in a very long time. Like, I wasn't trading when interest rates were above this point. I was trading when interest rates were in the 2s, and then we brought them from the 2s down to almost 0. So I haven't seen 4%, 5% like they're talking about. And that's going to really limit the market's ability to go up. Like 2021, so many restrictions had been lifted that the market was able to do all that. We just don't have that anymore. The Fed isn't buying crazy junk bonds to save companies that are going under. The Fed isn't making money extremely cheap to borrow. The repo market isn't going as nuts as it was before. Like everything has calmed down. So we're starting to see the effects of that. Okay, so the next one was GDP. Q3 GDP was 2.6%. The estimates were 2.4%. So GDP came in above what people thought. We're producing more goods and services than the estimates. So, I mean, that's another reason why I think this is going to take a little bit longer, right? And the whole pivot talk, no, like unemployment, it's barely moved. GDP is above what we thought. Like there are still reasons why the market's going to continue to, or the Fed is going to continue to hold things down because man, I got to think of a good analogy for this, but it's like when something has a lot of force, like your car doesn't just stop on a dime, right? It has to slow to a stop because there's so much force pushing it in the direction that it's going. It's the same way with the Fed, with GDP, with everything in the market. There are so many people that are in that mix that when you start to put the brakes on, it doesn't instantly stop. It has to slow, and it could start going backwards, but we're still in the phase where it's slowing. Like we haven't stopped at the light yet. We're still applying the brakes where, it was going 60 and now we're going like 55 or 50 or something. Like, we still have a ways to go before we're even close to stopping. So the fact that GDP is still growing and unemployment's still pretty low, that tells me that we're going to be in this for a while. So then non-farm payrolls, there were more jobs. It was like 261,000 versus the estimates of 200,000. So that's another 61,000 jobs that we weren't expecting. Again, like I'm saying, that's stronger growth. So yet another reason why there wouldn't be a pivot anytime soon. PCE came in at 5.1. The estimates were 5.2. So that's a little lower. I mean, that's not really a lot, but that's something to take a look at. I mean, prices have changed. If you look at energy prices like fuel has gone down quite a bit. It's still really high. I mean, it's way higher than it was a year or two ago. But I mean, the gas station by my house was like peaking at about $7, and now it's in the fives, like the mid fives. So that's a significant drop. It's still not. Before all this happened, it was like 2 or 3. You know, maybe some people had like under $2, but I live in California where there's extreme taxes on anything energy. So anything that's not green energy. So gas is a lot more expensive in California than other places. So for me, $3 something a gallon, that's a good price. You know, like if I can get it, if it goes down to 350, 380, something like that, that's great. I'm good with that. You know, that's more like what it was back when the Iraq war was starting up and everything was going crazy back then. So yeah. So anyway, things are still moving. The consumer sentiment is exactly where it was, 59, or where it was estimated, 59.8%. That's basically telling you what people think about the market. And there's still, I mean, the people are afraid, but there's still a lot of bulls out there. We need to get some of those out. And the JOLTS came in at 10.7. The estimates were 10 million. That's yet another job thing. So, okay, now, here's why I say some of the stuff I'm saying. The Fed President Evans, he says peak rates in December projections will most likely be higher than in September projections. So that's what we know. So they're moving the projections up a little bit, most likely, and we won't know until the next meeting. Also, we're no longer front-loading rates at this point. So the talk has been like, we need to jack rates up initially so that later on it's not so bad. Well, we're past that initial part. It's no longer the front, like we're in the mix of it now. So we can't front load rates anymore is basically what he's saying. It's like we've moved into the next step of the plan. Like now that things are starting to move, we're in the mid section of it. We were in the early stages, now we're in the mid section. So you have to start thinking about that. Like this isn't early anymore. We've made some progress. Things have started. Now where do we go from here? So the other thing is smaller rate hikes are going to make sense now. And here's the thing, 50 basis points would still technically be a big hike. We've had 75 basis point hikes for the past 4 or 5 meetings. That's insane. We haven't seen that in a long time, if at all. I mean, well, maybe, in the late 70s, early 80s when they were going crazy with rates. In recent history, 75 basis point rate hikes per meeting is huge. So even if we got a 50, that would be big, because most rate hikes are like 0.25%, maybe less. Even if they did a 50, that's still big. So I think 50's on the table. Some people keep talking about 75. We'll know when it's closer. But that Evans is thinking, 50 could be good. Could go with a 50 and then a series of 25s closer to the peak, or maybe just 25s. So basically we're moving down from the extreme rate hikes to the smaller ones. They're going to kind of finesse these now. So I wouldn't be surprised if we got a 25 or a 50 for the next one. My guess right now would be 50. I don't think 25 is there quite yet because they're talking about rates being over 5% when it finishes. So I'm thinking 50, even 75. So 25 to 75 is the range, most likely around 50 at this point. So let's see the other thing. So here was something interesting. Rate increases means the Fed pays more interest to banks. So banks will have holdings with the Fed that they're earning interest on. And because rates are higher, the Fed has to pay the banks more. So now they're not making money like they were before. They're actually losing money on this stuff. So that also means that they can't give their profits to the U.S. Treasury. So the Fed would take the profits, give them to the Treasury, and the Treasury would use it to lower the deficit a little bit. So it's not all about taxes and stuff like that, too. Sometimes it's about the Fed. We're talking about the Fed as an independent agency. Oh, yeah, well, then why is it giving money directly to the U.S. government? Come on. It's clearly a part of the government. It has to operate as an independent entity to do what it does. Also, the other thing is the bonds that central banks bought are dropping in price, so investors are selling them to get into the new bonds with the higher interest rates. So that's another place that they're losing money. I mean, there's a whole bunch of reasons why the people that were making money are now losing it, and it's starting to transfer into the hands of some other people, and that's what we need. We need money to move around. The Fed was letting stuff into the economy. They were opening the spigot, and now they're tightening the spigot, and all the money that was going to the areas that were hurting us needs to get pumped out. So let's see, the next thing. Here we go. This is what I was talking about. So there's a Robinhood article that says, we studied 8 recessionary environments going back to 1970. In all but one, measures such as industrial production, payrolls, and GDP bottomed on average of 4 to 5 months after the stock market hit a bottom and began to rally. This is why I say people are not going to be ready for the rally. It's going to take a while. It's going to hurt. You're going to get some bull traps, think it's the rally, and get crushed. But eventually the rally is going to come. And it's going to crush the people that double down and triple down and quadruple down, and then they're going to get wiped out. You know, not everybody's going to do that. Some people are going to switch because they're going to say, hey, I'm getting beat up. But the perma bears, they're going to get crushed. And the perma bears are the ones that provide the initial fuel to get everything going. Because once it starts to go, then the bulls get confident again, and they take over from there. It's like first the bears have to get squeezed out. Then the bulls have to be confident that this rally isn't going to get crushed. That's difficult because the bulls have been getting crushed on every rally. So they're really skittish about buying. That's what you have to think about when you're making trades or you're investing. The market is skittish. Traders, investors, the buyers are skittish. They don't want to pay too much, and they want to sell quickly when they have gains. Like in 2021, people didn't want to sell because the market kept going up. It didn't make sense to sell. You just want to sit on it. Like, okay, we have a down day or a down week. Eventually, it's going to go back up. Right? But now it's the other way around. We have an up week. You better get out of that thing because we're going to be down quite a bit. So what do we have here? In Ashton, Phoenix. I pay taxes to the U.S. government at least once a paycheck. Yeah, I mean, there's so many taxes. There's taxes, there's loans, there's profits coming from it's ridiculous. Our whole system is ridiculous. The only other thing I had on the list was the Twitter thing. Elon officially owns Twitter now. They took it private, and they fired some of the old regime. Probably going to fire more. In fact, I think they did the other day. They also might start charging for that blue checkmark thing. There's that whole $8 account deal now. I guess you can pay $8 to do your Twitter thing, be a verified account. I don't know. That was really the only thing. I mean, we were waiting for that Twitter thing to stop because I got involved at the beginning. I got chewed up in it because I picked the right direction, but it moved the other way for a few days first, so I got out of it with a little bit of a loss. And of course, right after I did that, it switched around and I would have made a bunch of money. So I just got out of it and was waiting for Twitter to be done. And now it's done and it's private. So you can't really trade it or do anything about it. So I'm putting Twitter out of my mind. I don't want to think about it ever again. You know, it's like I had a bad experience with it and I'm tired of people talking about it. So we're done. Forget Twitter. Twitter's over. There is no more Twitter. I do have a Twitter, by the way. And it's twitter.com/Astocalypse now. I don't do much with it. I'm trying to pick it up a little bit more, but I'm on there. I'm not verified. I ain't paying Elon $8. Forget that. I mean, other people can pay him $8. All right, I am going to wind this thing down and get out of here. If anybody has any stocks they want to talk about, throw them in the chat now. I'm going to be working on things, so hopefully the next stream will be a little better. Today was quite a disaster. The whole week was a disaster. Just had a bad Fed stream. I had technical problems with this. You know, there's more I want to talk about. I can't even remember what it was. But the whole point of this thing, the thing I really wanted to get through is like, if you expect something and it happens, don't chase it afterwards if you missed it. That's the big point. Like anytime you have a really big loss, you're going to have the emotional part. Once you get over that emotional part, then you can sit down and analyze what went wrong. And that's what I did with this trade. I kind of I forgot about it for a few days just to let myself calm down. And then I looked at it and said, okay, well, what was it that actually caused this problem? It was the fact that I was chasing a move that already happened, hoping I would get more. And when it started to go against me in an environment where people are skittish, I didn't take my money out. If people are going to be confident enough to keep buying, then you can do what I did. Then you can ride it and wait those little dips out. But when you're in a market where it's more likely down than up, that you just need to be safe and get out while you can. Even if you're break even or you're down a little bit, if it doesn't look good, just get out of it. That's the best way to go. It's very difficult to catch a bull run in this market. There are going to be bull runs all the time, but it's going to be difficult to catch up. It's hard to time. So in my opinion, it's just so much better to buy. That's what I've been doing. Just buying the things I like even more. I've got a bunch of leaps, man. I like Verizon leaps. You know, I like some cannabis leaps in case we eventually have a pop, but I don't really want to put a bunch into those, so I'm not doing too much with that. But I'm looking at cryptocurrency a little bit. I'm looking at the overall stock. Oh man, like Facebook, Amazon. Those are amazing buys right now. Like Facebook to me is one of the best ones because it's so hated. I was talking to somebody the other day and they were like, "Oh, Facebook's trash. It's going down to $47." And I said, I really hope it goes down to $47, but I just don't think it's going to. And he goes, I'd like to hear your bull thesis on it. So I said, all right, well, they've got a bunch of cash. You know, like right now, the big problem is they're dumping a bunch of money into the metaverse. It's just a big furnace for money. And that's hurting investors because they're thinking, why do I want to invest in this if they're going to be losing money in the short term trying to get this metaverse thing to work? And people are comparing it to Roblox and all that. And they're like, oh, look, Roblox has more people on it. It's a better setup. I think it probably is. I really haven't looked into it that much. But the fact that they're working on it and it's a company that's big enough and has the cash to do what they need to do, I mean, they can, even though they're spending a lot on this, they can still buy up competitors. I mean, they bought Instagram, they bought WhatsApp. Like, these are huge platforms that so many people use right now. So the fact that people think Facebook is done is hilarious to me. The lower Facebook goes, the better. I like shares of that. I've been buying shares. I really wanted to get leaps on it, but they're just so expensive that I think I'm just going to buy the shares and kind of, I'm not going to make as much on it. Like, yeah, you can make a lot more with options, but the shares will last longer, so I can add to them. Like Amazon and Facebook, I'm adding to. I mean, every single time, you know, when I go to buy, I usually try to buy monthly if I can. You know, I go in there. The first thing I do is like, let's get some Amazon, let's get some Facebook, and then I start looking at the leaps. Like, all right, can I get some Verizon leaps? I have Verizon shares because I want the dividend, so I buy some Verizon shares. I've got MPW, which is it's a REIT, medical REIT basically, and it does really well. It's cheap right now. It's paying the same dividend it was paying in the $20 mark, but now it's in the low teens. So to me, that's wonderful. Like, that's what I like about dividend stocks. They're still paying what they were paying when they were twice the price. So you're basically getting double the value for it, man. This is why I love this. It's buy time. See, what about Apple? It's under 140. Apple's good. I mean, everything's down. See, Apple's also tech. Anything tech is getting hammered extra because it's tech. Let's take a look at Apple and see what it's doing. See, Apple's a little bit more stable than some of the other stocks because people were fleeing to Apple for safety. And you can see it was just trending up, and it kind of hit a ceiling, and it's been volatile in that ceiling. But look at this chart okay, so this is Apple over the year, right? Here's the start of the year. It is barely down, right? Yeah, 180 was the peak, yes. But it's not that far, only 140, 138. That's not that far down. If you look at anything else, like let's look at Amazon real quick. That looks a lot worse, doesn't it? Amazon is this chart is just down. Apple's is sideways with a slight downward trend. Amazon is down. Now let's look at an even worse one. Let's look at the dreaded Meta. Look at Meta. Ouch. It is still Facebook. It is still Instagram. It is still WhatsApp. It is still Oculus. Yeah, it's the metaverse. It's funny. But it's a useful product, all right? Put your bias aside and think about this. How useful is it for somebody that is a business person that travels around to have meetings with people? They say they live in Ohio, and they've got meetings in Florida. They've got meetings in Seattle. They've got meetings in New York, all over the place. Instead of having to fly to all those places, they can put on the stupid goggles and take their little Wii avatar into their meeting. It looks dumb, but that way you don't have to travel. That saves all this money on travel. That makes it easier to just do everything from the comfort of your own home. Like, yeah, I mean, there's the argument about, you know, are people going back to work? Are there people that are quiet quitting? Blah, 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 blah. Yes, whatever. There's all that. But if in the future, if something is useful, it will be used more and more. And we're getting a generation of people that are growing up with this stuff as normal. Most people, like even Gen Z, this is still new to them. They've been like some of the stuff they've been doing for the past, 5, 6, 7 years or whatever. But really, that's kind of when this stuff was becoming popular enough for the average person to do it. So it's still really new. So the generation that's coming in after Gen Z is going to be immersed in this. And they're going to grow up with it. They're going to be using this kind of stuff when they're 8 years old, when they're 10, 15, whatever it is. And other people like Gen Z and millennials, they're using it now and they're going to be using it more in the future. Gen X, even the boomers are going to be in. Everybody comes in at some point. Yes, we complain about it, but we're dragged into the future kicking and screaming. What do we got here from Ash and Phoenix? VRC has hand tracking, good enough to do ASL. Metaverse is trying to figure out the legs. Yeah, I know. I was laughing about that because legs apparently are extremely difficult. So were hands, by the way. The hands, I guess, are really hard too. But trying to get legs in there, there's just so much to do right now. It's still in its infancy, which is why the chart looks like this. If you're throwing money at this right now, it's going to get burned up because they're not going to make progress very quickly. There are so many issues to deal with. But here's the thing, though. It's doable. Like all the stuff that they want to do is doable. They just have to work on it for a while. It's just going to take some time and some money. So at some point, this thing's going to flip around. And here's the other side of this coin. Let's say the metaverse is absolute trash. They can never get it. All the bears are right. And they just waste money on it for a few years. You know what they end up doing? They dump the project. And then they continue being everything else that they already are. They continue being Facebook and Instagram and WhatsApp and Oculus and whatever else they're doing. There's a reason for them to stay around if the metaverse isn't even a part of their thing. But I do think it's going to be a part of their thing. So I love this. I've been buying this one more. Like, I was buying it as it started to come down here, and then after this crash, I stepped up my buying. This is one of the reasons why I don't have a lot of cash right now, because I was like, ooh, I got to add some more of this metaverse down here or this meta down here in the 90s. It was dipping in the 80s. I bought something like 88 the other day. You know, if it keeps going down the low 80s and the 70s, I'm going to keep buying. I'm going to keep buying it. I love this for the future. Because look at how highly is Meta weighted in the indexes. What happens in a bull market to stocks like Meta, to stocks like Amazon? That's what you have to ask yourself. Yes, it's crap right now, but what do these stocks do in the reverse, right? These are proven, tried and true stocks. These are the big boys. It's not like some penny stock that's sitting around at 2 cents and maybe it'll jump to 10 and you can make a whole bunch of money or whatever, but it's some fraud business that you don't even know. You've never seen it. You can't drive by wherever the main location is. With Facebook, you use it. You can use Instagram. People still use Instagram all the time. They use Facebook all the time. People say they don't, but Facebook's still going strong. I mean, it's not like growing the way it was before. There's still so many, like, it's used for business. It's used a lot for business, actually. I still use it to keep in contact with a lot of people, because people will have a Facebook, but they won't have an Instagram. They won't have a YouTube or a TikTok or a Twitter, but they'll have a Facebook. So it's kind of like the staple. It's just cool to hate on it, right? So, okay, here's my comparison. Here's what I told the dude that was telling me he hated it the other day. I was like, listen, I like Metaverse. All right, I think it's all silly too, but they're basically Nickelback. All right, like, think about Nickelback. Nickelback is extremely popular, but they're terrible. Why are they popular? You know why they're popular? Because if you put your judgment aside, they're fine. They use all the pop tricks that make their song sound good in a pop fashion, right? There's nothing new. There's nothing that's going to surprise you, nothing that's going to wow you. It's just all tried and true methods that we know work based on human physiology. Like, this sounds good. These kind of things sound good generally to people. And the way you associate those things can make you think it's bad. That's why people don't like pop music, because, like, they associate pop with the image. They don't like the image of pop. And when they hear it, there's a primal reaction the second you hear a song like that. And then the rest of you comes in and says, no, I'm not supposed to like that. I'm too cool to like that. I have to think it's dumb. That's what our body does. Our body says, like, oh, we like this. And the mind says, no, you don't. I control everything. I live in a fantasy world, so I'm going to tell you that whatever I says is the way it is, so I'm suppressing you. That's what your body does. And that's why people like Nickelback. Because the people that don't care about that, they're like, oh, it sounds good because it's, just some normal stuff that works well with the human ear. It's nothing special. You're not going to be wowed by it. But if you just listen to it and you don't care about it, it doesn't bother me. You know what I mean? Like, I like to make fun of it too. I think it's very cheesy and, I'm just not a fan. I don't really want to listen to Nickelback. But when I do hear it, it doesn't make me go like, ugh, God. So Meta is the same exact thing. It's like Nickelback. People love to rag on it, but yet Nickelback just continues to go. They keep making more money. They keep getting more successful. With all the hate brings them more success. Meta is the same way. People will hate on it, but it's continuing to be used. If people were hating on it and it was fading out, that would be a different thing. But when people hate on it and it doesn't go anywhere or it continues to grow, that's when you know you have something good. Like, anything you're afraid of because it offends you, because you like something similar that's different, you feel threatened by that thing, that's how you know it's a good investment. Like, I used to invest based on my mind. Now I invest based on my gut. So if my gut tells me something, I take it seriously. I don't use my mind to go, no, I don't like that because I'm not supposed to like that, because I was told that I'm supposed to be cool and not like Nickelback, so I'm not going to like Nickelback. I don't like Meta. Meta isn't cool enough. It's stupid. Nobody uses Facebook. With the metaverse, where are their legs? Oh, the graphics are bad. Ugh. But is it useful? Yeah. Well, there you go. It's useful. Fuck. Right? So buy it. If you really like it, buy it. Don't worry about it. If it goes down, big fucking deal. It's going to go down. That's how it goes. You have to take the pain in order for it to turn around. Like, this isn't going to just stop tomorrow. This is going to suck for a while. But once it stops sucking, you're going to be glad that you did. Because what else are you going to do with that money? Think about it. What are you going to do with that money? You're going to go buy a bunch of cheeseburgers? You're going to go, like, buy some streaming service? Are you going to, go spend it on, like, porn or something like that? Dude, that money's just going to go away if you do any of that stuff. It's not going to matter in the long run. But if you buy and it goes down a little bit and then it rebounds, that money that you spent then will pay you in spades later on. So what do we have here? My point is that VRC can be used for everything that Metaverse is trying to do. I think it's going to win long term because of the Facebook name, but I think VRC isn't going away. Yeah, that's the thing. They have the name, and anything that's a big competition to them, they can eventually, hopefully, well, not always, but they can sometimes buy things out. They can make it more difficult. They can lobby for things. Like, there are so many ways that Metaverse can come out on top, regardless of them having a superior product. Right? I don't know how many people know about the difference between VHS tapes and beta tapes. Like, beta tapes were a superior technology, but VHS won out because it was easier to make. It was promoted better. You know, it just became more popular because it was easier from a business sense, even though it was an inferior product. Now, I don't know the specifics about it, so there's probably some nerd that's going to be like, actually, well, I don't care about that. The overall thing is VHS won out over beta. It wasn't as good of a product as beta for the most part, but it won because of the business part of it. And it's the same thing with Facebook. Facebook already is established. They have this big name. They have all this money. They have tons of brilliant people that can work on things for them. So why is it going to get crushed by anything else? It might if there's a really superior product that just blows it out of the water. Yes, but what if they buy it? What if they change what they're doing to match it? What if they make the regulatory environment more difficult for those other companies? There are just like I said, there are tons of reasons why they could come out. They've got the big mass. They've got the team to be able to move the ball down the field. So I like them. You know, like I said, none of this is financial advice. This is just all my opinion. You know, don't go dumping all your money into anything that I like or whatever. Don't, you know, make your own decisions, do your own research, and like make sure you're investing the way you should be. Like, if you can't lose money, don't invest it. Only invest with the money that you're okay losing. And with me, the money I'm okay losing in a stock like this. Because if I put it into freaking, you know, penny stocks and I lose all my money, well, that's on me. That was stupid. I didn't know anything about that stock. But Meta, I know a lot about it. I've used Facebook for years. I used Instagram for years. Excuse me. A lot of people I know try to get me to use WhatsApp, but I don't want to do it. I refuse. I refuse to use all those things. And I'm eventually going to use them because, you know, it's just like you get older and you start hating things irrationally. And that's what I'm doing with that. It's like, no, it's different. I don't like it. I don't want to use it. I like my old way of doing things. I'm just going to do that until I'm forced kicking and screaming to switch over to the new thing. And then I'm going to be like, oh, this new thing's actually really convenient. That's what happens every time. And I'm not the only one that does that. Everybody does that. That's why people are behind the times. That's why people hate Meta, because they're still looking at Meta as this one thing. They're not looking at Meta as this ecosystem. Like Tesla. People get Tesla now, but while it was going up, they didn't understand that Tesla isn't just a car maker. It's an ecosystem. It's a growing ecosystem that'll be part of so much more, i.e. insurance, the power grid. I mean, they're getting into industries that haven't been disrupted in a long time, and they're doing it well for the most part. So that's why Tesla is so popular, because it's got so much to it. And everybody that just looks at it like a car manufacturer is missing the big picture. They're not looking at the whole thing. They're looking at a very superficial piece of it, and that's why they're not getting the whole data. So I got to wind this down a little bit. This was a crappy week. Absolutely horrible, but that's okay. The way you succeed as a trader is by reacting to weeks like this. How do you react to a crappy week? How do you react to a big loss? Do you get all butthurt and leave the market and never come back? Or do you pick yourself back up, take the hit, and get back out there? Get back in the training, get back on the field. You know, it's going to happen again. You just got to keep going, because the way you succeed is by outlasting people, not being the best. All right, I'm a Stock Lips. This was Sunday Night Finance. Thank you for joining me. I'll be back in 2 weeks with another episode every other week, 3 to 5 p.m. usually, as long as my freaking setup actually works, which next week it's going to, because I'm going to be able to work on it in the meantime. But I'll be back then. We'll figure out what's going on. The elections will have finished. We can talk about that. CPI will have finished. We can talk about that. But what we're going to end up looking at is the next Fed meeting and the end of the year. That's what we got coming up. So save some cash. If you're looking at a tax loss selling grab, try to save some cash. Like you might be tempted to buy as things drop over the next few weeks, assuming they do. But at some point, when we get into that December area, is probably where a good bottom might be. Now, we could continue to drop into next year, which I actually think is likely, but I do think we're going to have some kind of a pretty big rally at some point in the next month or two, just because we've had so much bearish action and we have so much pent up aggression that it needs to be relieved to the upside at some point. Now, I don't think that rally is going to continue and be the next leg into the next bull market, but I do think we're over, I don't like to say overdue for a rally, but we're kind of overdue for a rally. So I'm trying to save some cash to get in on that a little bit, and then hopefully pick myself up and, come back better than I was before. So have a good weekend. Thanks for joining me. I will see you in 2 weeks. Have a good weekend and be safe.